What's up, guys? Welcome to Investing by the Numbers. I'm Simon Thompson, and today we're going to cover the top 10 Canadian dividend stocks to hold in your portfolio if you're a long-term buy and hold investor. Together, these create a safe portfolio with plenty of upside and a strong dividend yield of an average of about 5%, 5.5%, depending on where you buy these stocks at. So we're going to spend about 1 minute on all 10 of these stocks and give you a lightning quick breakdown. And if you want to learn more, I'll link below. I do a detailed analysis on a lot of these stocks in my other videos, but here we're just going to show you quickly why these are such an amazing part of any long-term investor's portfolio. So TD Bank is paying a dividend yield of 4.81% right now. Along with the rest of the market, it has really shot up since the crash, and it is my largest holding in my portfolio. So TD's revenue has been growing consistently over the past 10 years, plus their net income has been growing consistently during that time, and their dividends have been growing consistently as well, going from $1.22 per share in 2010 all the way up to $3.01 per share today. And we can look at their payout ratio as well and see that typically it's around 45%, and today it's about 50%, which is amazing. TD has a strong financial position with $521 billion in cash currently. So if you watch my other videos, you know that I love strong insider holdings because it aligns my interests with the interests of those who are running the company. And the CEO owns $40 million worth of shares, plus the CFO owns $26 million, and the group wholesale head of banking owns $37 million. So overall, TD is my largest holding in my portfolio and is my number one recommendation if you're just getting started or even if you are an intermediate investor. Next, we can look at Bank of Nova Scotia, which is paying out a dividend yield of almost 6% at today's prices and is one of Canada's big five banks. Similar to TD, the revenues have been growing substantially over time, the net income has been growing substantially over time, and the payout ratio is in the neighborhood of 45 to 50%, which is right in that sweet spot we like to see. It means they can easily pay out their dividend and continue to grow the business. And finally, we can take a look at the dividends, and the dividend has been growing from $1.96 per share to $3.57 per share 10 years later. Bank of Nova Scotia also has $411 billion in cash, so they have a strong financial position, and all of the Canadian banks really are in strong shape here and should be able to withstand the potential economic downturn that we're going into here. Enbridge is a natural gas and oil infrastructure company, and they pay out a current dividend of 7.15%, and of course their stock has been growing along with the rest of the market. Enbridge has consistently grown revenues over the past 10 years, and of course their dividend has more than tripled over that time as well. Their payout ratio is in decent shape. You calculate it using a measure based on their cash flows, and so it's around 60 or 70% at the moment. I made another video on this, and you can check that out. I'll link it below. Here we can see a map of Enbridge's infrastructure assets, and you can see that they just have a huge network which cannot be replicated. And what this means is they have a strong economic moat, and an economic moat simply means that their revenues and profits are protected into the future. You can see the value of these assets here in their financial health, so they have a huge net asset position. And Enbridge has pretty decent insider holdings, with the CEO owning 39.4 million, and this board member here, Gregory Abel, owning 29.2 million, and David Tutcher owning 28.6 million. So for me, this is one of my top 3 Canadian dividend stocks. It's a long-term hold, and I'm very bullish on it over the next 10 years. Next is Fortis, which is a utility company. They have a 3.54% dividend yield. It's very stable. Utilities tend to have stable cash flows during even difficult economic times because people are going to spend money to keep the lights on. Fortis has been growing their revenues consistently over the past 10 years. Their net income has grown consistently during that time, and the payout ratio is pretty solid, sitting at about 50% right now, so that dividend is very safe. And the dividend itself has grown from $1.12 to $1.85, so solid growth during that time as well. The insider holdings in Fortis are okay as well, with the CEO owning 17.3 million and many of the other executives owning well over 2 million in shares, as well as Nora Duke owning 5.9 million. Overall, Fortis is a stable utility, a safe investment for the conservative investor. And again, you can look for it potentially at lower prices if you're looking to get a bit more value. But over the long term, this stock should do fairly well for you and continue to raise its dividend. Next is Brookfield Infrastructure Partners. They pay a dividend yield of 3.16%. Right now, another safe and stable company to invest in. There was a very sharp rebound after the crash because these utilities tend to have stable cash flows, so the market realized that this was undervalued and gobbled it up, and I actually was lucky enough to buy during that time as well. Brookfield has been growing its revenues massively over the past few years, and its dividend has been rising as well from 73 cents a share in 2010 all the way up to $2.04 a share 10 years later, almost tripling. And we can also see that they have very strong cash flow in the last few years, meaning that that dividend is easily paid. If you use the cash flows to calculate the dividend payout ratio, it's around 60% right now, so it's in good shape. In March, Brookfield Infrastructure's CEO Samuel Pollock bought $780,000 worth of shares, so that's a strong insider move. And overall, Brookfield has $1.7 billion in cash and short-term investments. So Brookfield Infrastructure Partners owns and operates utilities, transport, energy, and data infrastructure businesses in North and South America, Europe, and Asia Pacific. So this is a company that has a diversified asset set across the globe. So overall, Brookfield is a safe long-term investment. You're not going to get a massive dividend yield, but the dividend is very safe, and it is a company that is going to continue to earn revenues despite economic turmoil. So for your more conservative investors, this is a great one. Next is Choice Properties Real Estate Investment Trust. They have a dividend of 5.4% right now. And this is a company that has over 80% of their tenants as grocery stores, so it's very stable cash flows. They have a partnership with Loblaws, which is the largest owner of grocery stores in Canada, including, of course, Loblaws and also other brands like Superstore. We can see that revenue has been growing consistently over time, and the dividend has also been increasing from 32 cents in 2013 all the way up to double that recently in 2020. And the payout ratio, if you base it on a cash flow basis, is at 40%. So they have very strong cash flows. As I mentioned, grocery stores are their main tenants, so very stable revenue. And the insider holdings are strong, with the CEO, Mr. Diamond, owning 18.4 million and the CFO owning 7.1 million of this business. Next is SmartCentres Real Estate Investment Trust, SRU.un, and I was buying this business back here at $18.50, and I made a YouTube video that covered it, recommending it around this price range at $20, and of course it has peaked up to $24 more recently, so gain of 20%. It's paying out 7.6% in a dividend yield. And SmartCentres Real Estate Investment Trust has been growing their revenue consistently as well, almost doubling from their 2010 levels, and their net income has remained quite strong. So the payout ratio is another thing we can look at. When we base it on the free cash flow, it's at around 80%, which is fairly typical for real estate investment trusts. They tend to pay out a much higher dividend yield, and that is just because they get tax benefits because of that. And SmartCentres has lower debt than many other real estate investment trusts, with their net assets over 10 billion and their net liabilities at just over 5 billion when you add up the total short-term and long-term. And we can also see here that on their balance sheet, they have 439 million in cash. And SmartCentres was started and is guided by Mitchell Goldhar, and he owns $395 million worth of stock, so he is heavily invested. Love to see strong insider holdings like this because these guys are playing to win over the long term. And you can see here when we scroll down that Mitchell Goldhar has been buying up a storm here even in May and in March. You can see he bought 1.5 million in May, 2 million in May here, another 1.3 million in March, and so on, another 1.5 million. So he's investing heavily into his own business right now, which is my absolute favorite thing to see. I deep dive on smart centers in one of my other videos. I will link it below for you. And this is a company that has Walmart as their biggest tenant, and overall they are going to do very well, I believe, in the long term. Next is Nutrien. They pay out a 4.8% dividend yield. They are the largest producer of potash and the third largest producer of nitrogen in the entire world. These are key ingredients for fertilizers, and they have 1,500 retail stores throughout North America. This is a great business for long-term potential, very safe and stable dividend. And this is a company that I deep dive on in another video. Again, I will link that below. I was recommending this company at $44, and also I was buying it back here at $40 and $41 and so on. And so if you subscribe to the channel, I'm really going to work on getting videos out about companies that I'm about to buy that I think are undervalued. So make sure you tune in for that. And also, if you can, hit that like button. I really appreciate the support. So Nutrien was formed in 2018 by the merger of two major companies. So these previous years don't really matter too much. But basically, this is a company that's continuing to grow their revenues, and they have a ton of advantages that, again, I explain in another video. I've linked that below. Definitely check that out. Next on the list is Telus, paying a 4.59% dividend yield as of right now. And again, this is another one that I was recommending back here when it was around $21, $22. It's obviously been ticking up. This is a very safe long-term investment that is going to pay their dividend quite easily. Of course, telecommunications, they tend to get paid even in difficult economic situations. Telus has been growing their revenues substantially over the last 10 years. Their net income, of course, has grown right along with that. And the dividend has more than doubled over the last 10 years, going from 50 cents to $1.15 today. The business has $1.1 billion in cash on hand. They have an 83% payout ratio, which is fairly high, but their revenues are so stable and their profits are so stable that they can easily afford to continue paying that. And they have decent insider holdings, with all of top management owning multiple millions worth of the stock. This is one of my core holdings. You can also look at Bell Mobility or even Rogers. They all are able to perform well because there's not too much competition in the industry. And overall, this is another great investment for a conservative portfolio. Finally, we'll cover Great-West Life. This was another one that I was recommending. I put out a video on this when this stock was down here at $20. So again, make sure if you want to learn more about this business, check out my videos that are linked below. This one is paying out a 6.81% dividend right now. GWO has grown revenue substantially over the past 10 years. And we can also see that their dividend has been slowly ticking up from $1.23 to $1.68 more recently. The dividend payout ratio is at 76%, which is slightly high, but the business can easily afford it because its revenues are very stable. And if you're worried about COVID, I think we're getting to the point where it's becoming less of a concern, at least for the next few months. We can see what happens in the winter. And Power Financial Corporation owns the vast majority of GWO, and in the video that I described, which again is linked below, you can learn all about the insider holdings for Great-West Life. Overall, this is a well-managed company with a great dividend yield, and we'll see what happens here going forward with the stock market. But these guys will be able to afford to pay this dividend even if more hard times are seen. All right, guys, so listen, these are great stocks for anyone who's getting a dividend portfolio started, or even if you're an intermediate investor, you can consider these, add them to your portfolio or build on your positions. These are really the core of my portfolio. Of course, the stock market has been booming since, a few weeks ago, late May. Things have really turned around here, but prices go up and down all the time. When we buy these stocks, we're not worried about where the price goes in the next few months. We're looking at 5 years, 10 years. We want to buy these businesses and hold them for the long term. Unless the fundamentals of the business change, we want to make sure that we're just holding them, collecting the dividends, and we're looking at that 10-year timeline, and we're allowing these businesses to grow and our portfolios to grow. All right, thanks so much for watching. Make sure to check out the videos below. I link all of them there. Again, I cover most of these stocks in really great detail, so I hope that you enjoy that and you can check out any videos that pop up right here.